Welcome to the segment called Inventory Valuation and Calculating the Cost of Goods Sold, part of the Reporting Business Income and Expenses video. With me is James Lee. Welcome, James. So first of all, can you tell us why a business owner needs to value their inventory?
To properly match expenses with income, you need to prepare an annual inventory. This is usually a list of goods held for sale. Inventory is used in the calculation of the cost of goods sold, which allows the calculation of net income on Form T2125, Statement of Business or Professional Activities.
How does a business owner figure out the value of their inventory?
The value you place on the items in your year-end inventory is important in determining your income. For income tax purposes, in most cases, either of the following two methods of valuing inventory is available. Valuation of each item in the inventory at the cost at which it was acquired, or its fair market value at the end of the year, whichever is lower, or valuation of the entire inventory at its fair market value at the end of the year. Other methods of valuing inventory may be available or required depending on the type of business. For example, property described in the inventory of a business that is an adventure or concern in the nature of trade must be valued at the cost at which the taxpayer acquired the property.
Is there a simple way to determine which method to choose?
Well, let's look at two examples. In the first example, there's a small business owner who operates an art gallery. Since he has a small inventory and the price of each item may be substantially different, he would probably opt to value each item in his inventory separately. An example of a business that would choose a value for the entire inventory is a dollar store. The inventory they have is similar in value or replacement cost, and they could choose to state the entire value of their inventory based only on the number of items on hand and at a value of $1 each. Business owners should also be aware that once they choose a method of inventory valuation, they must continue to use this method for the years that follow.
Now that we know how to value the inventory, how does a small business owner calculate their cost of goods sold?
Once the final inventory valuation has been made, the calculation of the cost of goods sold is a relatively simple calculation. You begin with the opening inventory, which is either the ending inventory from the previous fiscal period, or for a new business, the opening figure would be zero. To that, you add any inventory purchases made throughout the fiscal period, deduct the final closing inventory, and the final figure will be the cost of goods sold.
Thank you, James. This concludes the segment called Inventory Valuation and Calculating the Cost of Goods Sold, part of the CRA's Reporting Business Income and Expenses video. Thank you for watching.